you can recall that there are rationales for using individual valuation approaches. So out of the discounted cash flow techniques, we also provided a percentage which is close to 30%. The 30% analysts use the residual income valuation. So what is the concept of residual income valuation and when it is more appropriate? So you can recall the reasons when it is more appropriate. So when the firm free cash flow to equity is consistently negative, the firm does not pay dividend, and you do not have a better alternative of using the discounted cash flow techniques. In that case, residual income valuation can be one of the most useful techniques. And recently, the residual income valuation has been used by the analyst commonly. And the idea is more straightforward. And we'll be looking into the idea of residual income shortly. Before looking at the idea of the residual income, let me make it clear that residual income is known in different terms to you or to people. Some of the terms might be familiar with you. One alternative term is economic profit. Another alternative term is abnormal earnings or supernormal earnings. And another term is the economic value added. So this concept has a long history from the 1800s. This concept has been using this residual income, and this residual income comes or has become more useful because of a major shortcoming of the income statement. You can recall that what is the last item in the income statement? Can anyone please write? What is the last line item in the income statement? Is it the net income? Net income. Okay. So let me ask you some question. So this net income, does it account for expenses to be paid to the debt holders? Does net income account for expenses to be borne by the firm for the debt holders? No? Don't you subtract the interest expense for getting the net income? You subtract the interest expense for getting the net income. So does not net income account for expenses to be paid to the debt holders? Yes or no? Yes, but if I ask follow-up question, does the net income account for expenses to be paid to the equity holders? Equity does not come at free of cost, right? Equity comes at some cost. But the question is, does net income account for the cost to be paid to the equity holders? You have said the answer no. So if we subtract the cost of equity, from where? From the net income, this will give me residual income. This will give me residual income. So you might wonder how it is possible to get the cost of equity in terms of dollar number. So it is possible. So we'll show it that how it is possible to represent the cost of equity in terms of dollar number. So have we got the basic idea that how residual income comes in? Residual income comes from the shortcoming of the conventional accounting net income, which does not account for cost to be paid to the equity holders. Okay, so we'll charge the cost for equity holders and we'll subtract it from the net income, then we'll get the residual income. Okay, So let's try to define it more precisely. So if we start with the net income and we subtract the equity charge. So what is equity charge? Equity charge is the, you have the book value per share. This is your equity value per share in terms of book value. And you multiply this number by RE. RE indicates what? You know very well, RE indicates the cost of equity. So you measure the cost of equity in dollar term in this way, and you subtract it from EPS. From EPS, then you get the residual income per share. Now, is it in terms of total, if we take the net income here, and if we take the book value of shareholders' equity, in total, and multiply this by RE, we get the equity charge. And if we subtract this from the net income, we'll get the residual income. Okay. So alternatively, if we think of a big picture, it is the picture from the equity holders only. But if we think of the thing from the big picture, if we take starts with the EBIT, and if we subtract the tax, what is it? EBIT after tax, or the net operating profit after tax. What is it? Net operating profit after tax. Now, if we subtract after tax interest expense and cost of equity, this total after tax interest expense and cost of equity, what are our capital? Equity is our capital, debt is our capital. So if we subtract the cost of our total capital, that is known as the capital charge. This cost is in total known as capital charge. So if we subtract the capital charge from the net operating profit after tax, it will also give us the residual income. So we'll look at that how it is possible to get the residual income shortly from these numbers. Okay, you see that we observe the total asset of a firm is 5 million. EBIT is 400,000. Debt to capital ratio is 0.6. Cost of debt before tax is 8%. Cost of equity is 12%. Tax rate is 40%. Is it possible to have the net income here? Can you please take your calculator and give me the net income number very quick from these numbers? You have the EBIT number. You need to take the debt value by using this ratio on this total asset part. So out of 5 million, if we use the 60% as debt, our debt is 3 million, right? So for 3 million, we have cost of debt. How much? 8%. So take the 8% of 3 million. How much it is? Is it 240,000? It is 240,000, right? So from the EBIT number, where it is 400,000, if we subtract from the 400,000, if we subtract the interest expense of 240,000, how much is remaining? 160,000. 160,000 is remaining. How much percentage of income we can retain with ourselves? How much percentage of return we can keep with ourselves? This percentage we can keep with ourselves 60%. We have to pay to the government 40%. So 40% of 160,000 is 64,000. So if we pay tax of 64,000, we have how much net income remaining? We have net income remaining 96,000, right? So we have remaining net income of 96,000. So we have come up with a net income number. Now, How much of our capital is equity? How much of our capital is equity? We have the net income number here now. Now, let me write it here. How much of our capital is equity? 40%. So out of this 5 million, our capital, equity capital is 2 million, right? So can you recall that I showed you that how can we come up with the equity charts? We take the shareholders equity part here 2 million and we take the cost of equity. So if we multiply this number by 12%, how much it will be? It is the equity charge. How we are getting this? We have taken the equity value here and we have taken the cost of equity 12%. Would you please find out this number? So equity charge is 240,000. Equity charge is 240,000. Now, if we subtract the equity charge of 240,000 from the net income of 96,000, how much is remaining as residual income? How much is remaining as a residual income? Negative 144,000. Negative 144,000. So it is the residual income. So what we have done, we have used the application of this part. So if you are consistent, this should give you the same number. This should give you the same number. So let's start. NOPAT. What we have mentioned as a NOPAT. So we like to prove it that both give us same number. So it is our EBIT. So if we take the EBIT after tax, how much it is? 400,000 after tax. EBIT is our NOPAT. So what is NOPAT here? 240,000. NOPAT is 240,000. Okay, now we have to calculate what? We have to calculate the capital charge. So let's start with debt capital charge. So you already calculated debt capital charge, but now you have to come up with debt capital charge after tax. So what amount is our debt? 3 million, right? So 3 million multiplied by 8% after tax interest expense should be this one. Would you please find out this? And for equity, our equity capital is 2 million and our cost of equity is 12%. And this should be our cost of equity capital charge in terms of dollar. Would you please find out the number for these two? One, it is 144,000 and this one is 240,000. So what is the total capital charge? 144,000 plus 240,000. So in total it is 384,000. In total it is 384,000. So what should be the residual income? The residual income is the NOPAT 240,000 minus the capital charge of 384,000. So are you getting the same number of this? If you subtract the total capital charge from the NOPAT, you get the same number. So you got the equations. So it is not nothing. It is something the language of the concept or the mathematical language of the concept. Okay. So let's try to find out some facts from this calculation. Our net income is a positive number, right? Our net income is a positive number, 96,000. But our residual income is a negative number. So what does it mean? The firm can cover the debt capital charge, but the firm cannot cover the total capital charge. When the firm is covering total capital charge, the firm is getting negative residual income. Okay. The firm has an accounting profit. This net income is accounting profit, right? Can you recall the residual income? What we mentioned, this residual income is known as economic profit. So this firm does have a positive accounting profit, but this firm does not have positive economic profit, but the firm has negative economic profit. If the firm uses its capital, but they cannot make up the total cost of the capital, which is 384,000. Do you think the firm is generating value or the firm is destroying value? If the firm generates insufficient income for making up the charge of capital providers, the firm is creating value or the firm is destroying value? The firm is destroying value. Okay. So does this negative value of residual income mean that shareholders' opportunity cost is higher? So shareholders' opportunity cost can be represented by cost of equity. But when you see that residual income is negative, that means the firm is not generating enough to meet up the cost of equity also. So the equity holders are losing. Yeah, equity holders are losing. So this is the calculation what we already are done. Okay. So let's try to recap this concept. I believe that you are familiar with this concept. We already are done with economic value added concept, which is here, NOPAT. And this is the capital charge percentage or cost of capital, and it is the total capital. We are already done. But what we are doing, you can compare this with this one, market value added. So what is market value added? Have you heard about the Tobin skew from your monetary economics? Have you heard about the Tobin skew? So if you take the market value of your stock and the market value of your debt, I mean the market value of capital, and divide this number by the book value of your total capital, book value of equity, and the book value of debt, in that case, you will get the market value added. So you can easily understand that economic value added and market value added are two different things, but how they are related. Let me unlock the confusion here, that why we have written these two different concepts in a single slide. Okay. If the firm generates positive economic value added, okay, what should you expect? This should be a positive number, or this should be a zero, or this should be a negative number. If the firm generates enough or positive economic value added, what do you expect? If the firm generates positive economic value added, do you expect that market value added is likely to be positive number? So that is the reason that how these two are integrated or how these two are linked. Okay, but conceptually these are two different things. Okay, so we are applying the residual income here in the economic value added, and we are looking at the results or the performance of higher or positive residual income in the concept of market value added. Okay, so is it useful to use the residual income valuation? The answer is yes, that it is useful to use the residual income valuation. But why or for what purposes? It has been found that the firm's analysts are using the residual income to measure the value of firm, and later they have discovered that the valuation what they have done using the residual income correctly reflects the valuation what has been measured in the market later. And another thing we like to highlight regarding the usefulness of residual income is that American Accounting Association recommends the usage of the residual income valuation for measuring the depletion of the goodwill. You are familiar that how goodwill is generated in the firm when a firm purchases another firm or asset from another firm. They pay a higher price than the fair price. In that case, the excess price they pay for it is recorded as a goodwill in the accounting statement. But the valuation of the goodwill is little bit difficult and complex, and analysts go for using the residual income valuation to measure the valuation of goodwill in that case. And when the firms generate a higher or positive residual income, equity holders believe that firm managers are doing great for them and also for the firm itself. So executives are likely to get higher compensation when they are able to generate higher residual income for the equity, higher residual income from the firm. Okay, so we'll try to talk about more detail on the forecasting part of the residual income, but let's try to break down the definition of the residual income in more detail. So the definition what we have used earlier, we use the not or the present term. Okay, now what we are doing, we are wanting to forecast the residual income of a particular period. So how it is possible if we take the forecast of earnings per share and earnings per share of a particular period, and if we take the equity charge, which is represented by the book value of per share, and multiply by the cost of equity, this is the part which is known as equity charge. And if we subtract it from the earnings per share, we have the residual income for that particular period. Now, do not go for using the BT here, because here it should be the beginning value of equity. It should be the beginning value of equity, and you are calculating the equity charge in terms of the beginning value of equity in that period. Okay, so we'll show it in terms of number, but note that it is not in the same time denomination. So it is the period EPS, but the book value of equity is the beginning equity value per share. Okay, it is the beginning value. Remember it. So let's try to apply it. Why the beginning value? Because EPS is the number what you are getting in this period. Okay, at the end of the period. So you want to compensate to the equity holders for the capital what they provided you initially. You use the capital of the equity holders of which capital? The capital which has been available at this period or at this period. Which capital you have used over the time? You have used the capital which is available or which is reported at the end of the period, or the capital which was available at the beginning of the period. Which capital you have used throughout the year or throughout the period. So that is the reason. Thank you. Okay, so let's work on. We have some earnings number, we have some dividend number, we have some book value at the beginning, and we have required equity return. Okay, so do not forget the definition of the residual income. We need the earnings number. We need another number, which is the equity charge. And earnings of which, equity charge of which period? This period. Not this period, but this period numbers are necessary for forecasting the numbers for this later period. Okay, let's start. So we have the earnings number, and okay. So is it possible to come up with the book value of equity in this period? Are you familiar that a clean surplus accounting says that if we have the book value of equity at the beginning of the period, and if we have a positive or whatever the residual retained earnings, which is represented by earnings per share, and if we have any dividend payout or distribution, we'll get the book value of equity at the end of the year. Is it possible? Does it work? Are you familiar with this? Does it work in this way? Very quick. It works in a very simplest way. So let's start. So if the book value of equity beginning is 20 for this one, this period, and we have the earnings 2.5, and we have the dividend 1, what will be the ending book value for year 1? 20 plus 2.5 minus 1. It should be 21.5. Now, is it possible for getting the year 2 book value? So 21.5 plus 3, which is 24.5. And if we subtract, is it 24.4? What shall be the book value at the end of year 2? $23.4. Okay. 23.4. Okay. So I'm just showing you the calculation of book value and how book value works. But note that book value is not necessary, or book value is not the direct variable in the residual income calculation, but book value will be useful for having the calculation of equity charge, right? Let's start. So how can we calculate the equity charge for this period? You can recall this one. Okay. If we write the beginning equity value per share for this period, 20, multiplied by the equity charge, which is the 10%, right? So 10%, how much it is? 2 taka. And for this period, if we have the 21.5 book value of equity per share at the beginning, and if we multiply this by 10%, we have 2 point, how much? 2.15, is it? $2.15. Now, what shall be the residual income for year 1 and year 2? For year 1, residual income is this earnings 2.5 minus 2. How much it is? 0.5. And for year 2, 3 minus 2.15. How much it is? 0.85. Have you got the calculation of residual income? Very quick, please. Is it possible to come up with the forecast of residual income? So in this way, we can come up with a calculation of residual income. Okay. So then we shall talk about that how can we value the stock using the residual income number. So here the number we have calculated 0.5 for year 1 and 0.85 for year 2. So for valuation, we have to start with a book value at the beginning, and we have to discount the present value of all residual income or stream of all residual income cash flows. And when we do this, we have to discount this number by cost of equity. When we take the present value of all the stream, this one, we have to discount this by what? By the cost of equity. So this definition is more straightforward to you, that instead of residual income, because the residual income comes from this, we can write here. Okay, what is it? It is the EPS or earnings per share, and it is the book value per share at the beginning of the period, and it is the equity charge. Okay, so note that residual income valuation starts with this. Start with book value at the beginning of the period. Okay, so you shall see that you'll see that how it influences the value. Okay, so let's start with another example. The firm has a beginning book value at time 0, 20. We already have calculated residual income year in year 1, 0.5 residual income, in year 2, 0.85 residual required return 10%, and we have an additional assumption that residual income in year 3, $1. The firm ceases operation in 3 years. In that case, what do you think? We have to we have the stream of residual income for how many years? 1, 2, 3. For what reason? The firm ceases operation in 3 years. So after 3, the firm will discontinue. After 3, the firm will discontinue. So how can we come up with a valuation? Is it easier? So let's start with 20. And we have to discount the present value for how many residual income. For year 1, we have 0.5. For year 2, we have 0.85. For year 3, we have 1, right? So here you see that we have a cost of equity 1.10. We have a cost of equity 1.10 square. It should be 1.10 cube. Is it okay? Is this calculation straightforward? Would you please write the give me the number for this part? So how much it is? So try to understand the simplest part, because we will try to add some complexity later. if you do confusion or make confusion here, you will get confused later. So how much it is? You will get this number is 1.91. This number is 1.91. So in total, how much it is? In total, it is 21.91. Okay. So out of this 21.91, can you observe that 20 constitutes a significant value of this 21.91? 20 constitutes a significant value of 21.91. So you can understand that how large the portion of the beginning value or the book value of the equity is in residual income valuation. Okay. So here we already are done. We like to get a summary from our calculation. So it is possible to come up with this derivation if you just do the residual income. So earnings per share, can you recall the earnings per share and RE multiplied by BT minus 1. Okay. So I probably showed you in this in class. So what is EPS? EPS is the ROE multiplied by book value of equity at the beginning of the period minus the same thing, BT minus 1. Now, if you take the BT minus 1 or previous period common, this have this within the parenthesis, right? So from here, you can come up with some conclusion. What are the conclusion? The conclusion is that if the firm can generate positive return on equity over the required return on equity, the firm will have positive residual income. The firm will have positive residual income. If the firm has positive residual income, let's try to come up here. If this part is positive, this part is positive, do you think the value of the stock should be greater than the book value of equity? Because positive something is added for positive residual income. Okay, so this has been enumerated here. For positive residual income, you have higher value over the book value of equity and the vice versa. Okay, and this one is very simple. You see, if you understand it, it starts with the book value of equity at the very starting, right? So here you see that this part is the residual income, and this part we have explained here in this way. So if we have a positive residual income, what does it mean? This part will give us a positive number. So if this part is a positive number, if it is added with this, shouldn't the book valuation should be greater than the book value of equity? Or this will be equal? And the vice versa is true. Okay, so this is a very simple concept, way of showing the residual income valuation from the price to book multiple. And how can we come up with the price to book multiple? This is nothing, but let me show you that we are already done. We already have seen it. We already have seen it, that it is possible to come up with it, but you probably can recall that was shared with you in the price to book value multiple, and how can we come up with this? what is the point regarding the cease of operation after 3 years? So there will be nothing. At the cease of operation, the firm will have no existence. So you will have no value to be included here. Okay. So if we take a constant growth model, we can come up with this. For the sake of time, I'm not showing you how can we come up with this, but it is a very straight derivation. And you do not need to memorize all of this, how to come up with this definition and how can we come up with it. But you can recall that we explained this. We explained something that price to book value multiple is connected to the residual earnings, and this is the way that how they are connected. Okay, so if we have, if we take the book value in both sides, this side and this side, we get this, but how it is possible? So if we take this book value, this is the market price, market value over book value, and it will become 1 if we, as we are dividing both sides by book value of equity, and here it would be ROE minus R over R minus G. Okay. Now, with the 1, if we write the R minus G and R minus G, and here it is possible to come up here. So I'm not showing you the derivation for the sake of time, but what I want to say that this is something which is representing that if the firm has positive, if the firm has this number positive, the firm is generating greater return on equity over the cost of equity. In that case, you'll see the justified price to book value multiple, which is greater than 1, as this number is positive. And if this number is negative, you will see that the firm is generating price to book value multiple, or the firm has a price to book value multiple, which is less than 1. And here, what we are saying that price is equivalent to value. Okay. So this is not something useful for exam, and because we'll not test it. Rather, these are something which is more meaningful in terms of equation. But what we like to see, we like to extend our model of residual income for what happens if the firm grows after year 3. Okay. So this is a very straightforward if it is a single stage residual income model. Okay. So single stage residual income, how can you come up with the, you can probably recall the GGM, Gordon growth model. Okay. So this part is the simplest application of Gordon growth model, but how it is different, it is the, for the calculation of residual income, it is nothing special. Okay. But you have to start with, again, book value of equity. How much it is? 30. Okay, we start with 30, and ROE is the 18%, and cost of equity is 12%, which is the difference of 6%. We have the book value of equity share 30, and 0.6 multiplied by 30, 0.06 multiplied by 30, you'll get the residual income of 1.8, and you'll get the 75, which is the value of share using the residual income model. If we use the Gordon growth model, because the growth stage is a single stage growth model. Okay. So that is not something overly useful because that is the more simplistic scenario, but we like to discuss the finishing discussion regarding that what will happen if the firm grows after year 3. You can recall that the firm ceases operation in year 3. So after year 3, if the firm continues, what can happen? Residual income is likely to remain constant. Say, residual income was how much? $1. So it can remain constant at $1. Okay, it can be one scenario. Residual income is 0 at the terminal period. Residual income gradually declines to 0, where ROE is equal to R. So when ROE is equal to R, and it is only when there is a stiff competition in the market, the firm barely earns the cost of equity, and the firm cannot generate return on equity which is greater than R. And ROE gradually declines to a constant level where ROE is greater than R. Okay, so when it is possible that because of huge competition in the market, some firms exit from the market, and the remaining firm enjoys this higher return on equity over the cost of equity. But over time, it is likely that it will go. It will be equal. And if the firm is a diminishing stage, you will see that ROE is less than cost of equity. So these are some possible scenarios. So for these possible scenarios, we are likely to add a factor for considering the long-term residual income, and alternatively known as continuing residual income. So what is it? It is very simple that what is going to happen in the long term? What is going to happen in the long term, or what is going to happen after the initial stage of growth? You can recall the concept of H model. The firm grows at a faster rate, but later the growth rate declines, right? So you can relate it here. So what will happen in the long run? So in the long term, these situations can happen, but for counting these situations, there is a term which you'll be using, that is the omega. So this is the omega. What omega will indicate? Do not get hung up or get afraid by looking at some Latin symbol. The concept is very simple. If the firm is persistent, in terms of generating residual income in the future, omega is likely to be 1. If the firm residual income stop growing and declines to 0, in that case, it will the value of omega will become 0. So if the residual income does not fade, it continues at a constant level, in that case it will be 1. If it goes to 0, it declines, it stops to 0, in that case it will be, this factor becomes 0. Empirically, it has been found that omega, or the persistent factor, is equal to 0.62. So let's try to have some discussion that why the firm should have high persistent factor like 1, or the firm should have low persistent factor like 0. If the firm makes high investment, keep more money in their firm, pay less dividend to the firm, and less dividend to the equity holders, what do you expect? The firm has high persistence for what? High persistence for generating high residual income. And if the firm has historically high industry ROE, what do you expect? High industry ROE, what does it mean? In that case, what do you expect? ROE is a positive number or a good term. Okay, that are the reason for high persistence. And the opposite reasons are responsible for low persistence. The firm has a extreme ROE in past periods, but now the firm is expected to face this kind of situation. ROE is equal to R, or R is greater than ROE. or the firm has generated sales with extreme recognition of accruals, and the firm is likely to face difficulties in the coming period. So in that case, there will be low persistence. Okay. So we'll try to use this for accommodating what is going to happen after year 3. So don't get afraid by looking at the big formula. So this is not something difficult. We are already familiar with this part. We already have worked with this. But what has been added? This term has been added. So this term has been added for considering which issue, how the residual income will grow in longer period, longer term. For considering that, it has been included. Okay. So here the residual income which will be available at the last period of the growing phase. Let me show you some numbers. Okay. Here in year 1, year 2, year 3, the residual income are growing in some way, which is the last time at which the firm residual income grows, year 3. After year 3, the firm continues operation, but we will see that if the firm continues operation, but the growth will continue up to how many periods? Up to year 3. So here, the residual income of year 3 will be here. And the persistence factor will come from here. Our persistence factor, which will be given, this should be here. And try to understand what is T. Other things are familiar with you. What is T? T is equal to the ending of the growth period, or the index of the time at which growth period stops. From here, growth period stops in which time? Would you please write in the chat box? In year 1, 2, 3, growth period stops in which period? 1 out of 1, 2, 3. Growth period stops in year 3. So here, T is equal to, T should be equal to 3. T should be equal to 3. Now you see that if I ask you T minus 1, if I ask you T minus 1, what is it? 3 minus 1. Okay. So here it should be 2. So of which book value you should take here? Year 2 book value. You should take the book value of which year? You should take the book value of year 2 here. Okay. So we'll try to apply this. We'll try to apply this. In that case, it will be more clear to you. Okay. But the first part is more familiar, and the second part we like to add something. For which part? For the long period phase. Okay. So this is something with which you are already familiar. But here we have assumption the firm, instead of ceasing its operation, the firm will continue its operation after 3 years. So if the firm continues operation after 3 years, what might be the situation? So one situation is that omega is equal to 0. Would you please write what you mean by omega is equal to 0? When omega is equal to 0? Write on the chat box. So we'll check the calculation later. Omega is equal to 0. When it will happen? The firm residual income will stop growing, and the firm's residual income will go to yeah, here you see the firm residual income will not persist after the initial forecast rise, and it is likely to go to 0. Okay. So let's see if the omega is equal to 1. Okay. So this is nothing new to you. It is the book value at the beginning, which is given. It is the period one residual income, right? This is familiar with you, and you are discounting it. It is the residual income in year two. It's nothing special, okay? But at the last stage of the growth, you have to do some calculation. So what you see at the last stage, of the calculation, which residual income will come here? When the growth will stop. Growth will stop after year three. So you are taking the residual income of year three. You are taking the residual income of year three. These are all given. But if it is not given, you can easily come up with the calculation if you apply this, and we are familiar with this. And you see that 1 plus 0.10, it is like this, right? And what we are doing, we are subtracting 0. So why we are subtracting 0? Because persistent factor is 0. That's why we are subtracting 0. And here we are multiplying this by the factor, discount factor, which is 1 plus RE to the power t minus 1. So what is it? T is equal to what? T is equal to when the initial growth will stop. The initial growth will stop at year 3. So here we should write 1.10 cost of equity to the power this 2. So this 2 is coming from here. Okay. So in this way, we are getting 21.91. So in terms of calculation, this is nothing special. But here you see, if the persistent factor is 0, is it equal to 1.10 to the power cube? The denominator? It becomes 1.10 to the power 3. So it is nothing new. So it seems that we are doing the same thing what we did earlier. But when it will become different? It will become different when omega is not equal to 0. Okay, when omega is equal to 0, it essentially becomes equal to what we just did earlier. Okay, so let's see if the omega is equal to 1. If omega is equal to 1, what we will apply here? We will apply here 1. And if we apply 1 here, it will become, instead of 1.1, it becomes 0.1. And what we see, the value 29.42. And here the value we see 21.91. Is it consistent that when the firm has persistence indicated by omega, the firm should have higher value or the firm should have lower value? What do you expect? If the firm has persistence of higher residual income, the firm should have higher value. Now, if I ask you a question, if the firm omega is something which is greater than 0 but less than 1, which is more realistic? Let me remind you, which is the most realistic. Yeah, this one. You see, omega 0.62 is empirically found. What do you expect? The value should be in between 29.42 and 21.91. Do you expect the value of stock should be in between these two when the omega is in between 0 to 1? 0 and 1. Do you expect this? So this is the final case. This is the final case when omega is 0.60. You see that the value is 22.81. Okay. So instead of calculating the value in this way, you might have a value in the final year like this, which is more like the terminal value we calculated using the multiple. You can recall that it is possible to have the GTM model for the terminal value calculation or use the multiple for calculating the terminal value. So what we are doing the multiple uses for calculating the terminal value. So this is more straightforward, and you'll try to see that instead of if we have a terminal value, from here we can come up with the residual income in this way. And you see that book value in we have been said that book value in year 3 at the final year of our growth is 25. Okay, and price to book value is projected in year 3 as 1.1. So how can we come up with a price to price if we have the price to book value and also we have a book value? Okay, so here we have a price to book value multiple of 1.1 at which we'll be able to sell our stock, and book value is 25. Okay, so it is 27.5. What is it? It is the projected stock price in year 3. So this is the terminal value calculation. And if we have the terminal value calculation, and if we have the book, we have the book value at the beginning of the year 25, we see that this is the, what is it? This is the value addition from the market. By selling it, we'll be able to get this amount extra. Okay. So it is also possible to have the valuation in this way instead of what we did earlier. And these are how residual income and dividend and FCF valuations are connected. It is more straightforward. In residual income valuation, we are using the return on equity. We use the same return on equity in the dividend valuation and the FCF valuation. And here the calculation model is little bit different because we are adding the book value. We are adding the book value initially. But in the dividend and FCF model, what we are doing, we are just making the discounted present value of all equity cash flows. But you will see that if we use the same materials in both valuation or among all this valuation, you will see the value what you are getting from the residual income, what you are getting the dividend discount model, what you are getting from the FCF discount model. You will see that all these are same. There is no difference. Okay, so this is just kind of proof that all are giving you the same number. All are giving you the same number of the valuation, as long as the variables are consistently valued at the same number. Okay, so but there's a little bit difference that, as you already have seen, that residual income puts large weight on current book value, but the FCFE and the dividend discount model, can you recall the terminal value? Terminal value gets larger weight. Terminal value gets larger weight in this valuation. Okay. So there are several strengths and weakness. These are more subtle and these are more clear from what we discussed earlier or what we discussed throughout our discussion on the residual income. But one thing what we like to end here by saying that residual income is not appropriate if the firm does not have this accounting. What does it mean? Can you recall that we discussed the clean surplus and dirty surplus in one of our earlier classes? You know that beginning book value of equity plus earnings per share, then dividend should give you the ending book value. But we have a statement of comprehensive income where we add something which is gain or loss from the available securities available for sale, or currency translation from foreign subsidiaries. Can you recall this concept? So for these reasons, which are other comprehensive income, this equation does not work. This equation does not work. So if the firm does not have other comprehensive income, which we discussed in the reformulation of statement, reformulation of financial statement, in that case, the residual income will not work. Let me summarize it. If the firm does not have clean surplus accounting, that means if it is not true for the firm, in that case, residual income is not a good fit for the firm. Okay. So just like to highlight one of the examples which we discussed earlier. If the firm has a loss from foreign currency translation, in that case, you have to make some adjustment how your net income should be adjusted downward. Okay. So these are some exceptions where residual income needs to be accommodated, needs to be adjusted for having the dirty surplus issues. Okay. So that is all about for residual income, and like to